It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, national underwriter for Old Capital. It's Michael Becker. Michael, how are you?
Hey, doing well.
Michael in the podcast today. Good to see you in your own podcast. We appreciate that.
Yeah, 2 in a row.
I think that's lovely. So we are just finishing up on getting you, if you can, make it to the Old Capital Multifamily Conference. We do that once a year. Remember what we talked about last week, why we have our keynote speaker, Coach Lou Holtz. Coach is like you as a guarantor, key principal, lead, general partner. You are the guy who's on the sidelines coaching your team to be successful on the field. So we saw a lot of parallels between you as a key principal and a lead into the transaction versus the players that are on the team that are trying to win the game for you. You're not out there collecting the rents. You're not out there fixing plumbing. You're not out there cutting the grass. You're not out there operating the property itself on a daily basis. You have a third-party property management team. It's the same thing being Coach Lou Holtz. He had several successful teams, made it to the national championship a few times. He is a legendary coach. We brought him in to have him talk with you about doing the right thing. Doing the right thing not only for your players, which is your limited partners, and doing the right thing for the bank, doing the right thing for the transaction, but especially doing the right thing for your tenants, your customers into the deal. So Lou Holtz will be our keynote speaker. We'd love to have you come there, oldcapitalpodcast.com. Again, oldcapitalpodcast.com. We would love for you to be there. Again, this is not a regional conference. This is a national conference. We would want to see you network with some of the most successful multifamily investors in the nation at the conference in Dallas. So we'd love to do it. So, Michael, how are things been?
Yeah, things are good. Yeah, trying to finish the year off strong and navigate the choppy markets, and trying to put a bunch of offers out. Hopefully, a couple will stick here.
Now, you have just recently got an offer accepted. And I think this goes to the heart of what the question is for Ask Mike Mondays. Mike, before I put an LOI over to the seller through the listing agent, how deep should I go with my discussions with the lender to make sure the deal works?
Yeah, I think when you're starting out, most of these deals, I think you should at least get a quote or some form of fashion before you're getting super serious. At least have a conversation with Paul or James or Ricardo, one of the guys, that you kind of get a sense of like, hey, I'm underwriting 80%. Is that reality? Can we get there? Can we not get there? Most of these marketed deals here and the markets that we focus on, the Texas markets, we probably already have a term sheet in hand on most of these deals because we, being Paul, tries to see pretty much everything. So when we're out there doing it, sometimes we get a formal quote, Paul, sometimes we don't. But, we've seen many deals at this point. We bought a lot. We've, passed on far more than we ever purchased. So we've kind of gone through this dance quite a bit. But, if there's any deal and I'm kind of like unsure about it, I'll make sure we get a pretty good formal quote, or at least have one of my lenders go through and just kind of reevaluate what all my assumptions are, and make sure that I'm kind of getting the right debt assumptions. Sometimes if these deals are just off market and we're just kind of fishing a little bit, I don't want to waste everyone's time with doing formal quotes on something. But if it's like a fully marketed deal, I usually have them size it. I maybe don't make them go through the whole process and trying to call into Fannie Mae and try to see what kind of waivers we can get or anything like that. But at least kind of give them to give me kind of their best at gas. And then if we start getting some traction, I think at that point is when I really start getting pretty deep into it. But I think when you're starting out, especially if it's a marketed deal, I would certainly call one of the guys at Old Capital, because chances are they probably have a formal loan quote on it anyways.
Yeah, regardless if it's a transaction in Texas or it's a transaction in Illinois or California or Florida, we have the ability to do lending in those states. So always give us a call on that. But I think my question on top of that really is, it comes down to making, this is a big boys game in this transaction. If you do put an LOI and it does get accepted, you could be liable for the earnest money that is possibly going hard. And if you didn't vet out the lending side, which is about 70-80% of the money that's going to be brought to the table in these transactions, and that term sheet that you thought it said 80%, if you look a little carefully, it says, the maximum is 80%, but the loan amount is going to be closer, because they don't put what the loan, typically what the leverage is on the loan amount. They just tell you what the loan amount is. And maybe it's 72 or 73%. and then you find out that you cannot get 80% leverage in the deal, and you've made a tactical mistake. So make sure when you are serious about a deal, run it through maybe one or two lenders just for them to kind of figure it out, and then always ask for their sizing model on how they came to that number. And Michael, like you just got under a contract recently, and I would probably imagine you pushed off that deal until you found out specifically what type of financing was available and if it fit your model correctly for the yields that you were kind of expecting to your limited partners.
Yeah, I mean, certainly before you ever get into escrow, you want to make sure you have a really good, solid loan quote that you know exactly where you're going to be, or if you get the loan quote, and we always get the model because it's like hey, all these expenses matter, right? So income's kind of what the income is, right? So that's less you can do there. But if the lender's underwriting a certain tax number, a certain insurance number, and it's either high or low, you either have, they're being too conservative or maybe they're being too aggressive, and they're going to have to come back and retrade you on proceeds down the road. And that could, have a material impact on your returns. And, if the deals are thin, like a lot of the deals here lately, in general in the marketplace, it's not as easy as it was a few years ago from the return standpoint that, these details matter, that if, it works really good at 80%, but doesn't work as good at 76%. So kind of making sure you get through all those details. That kind of really separates the amateurs from the professionals, I think.
Details. When it comes to underwriting these transactions, sometimes people that lack the experience in multifamily, they're pretty good at Excel. But when they start trying to figure out how the numbers actually get placed in there, they may be coming off of an operating statement that has been done by a mom and pop. And like I just saw one yesterday, the day before, that the mom and pop forgot to put in property taxes and insurance into the deal. And so they just put their own number into the deal without really looking at the appraisal district or the county of what the taxes are. And they just put a WAG in of what they thought the insurance was going to be on the deal. And then they looked through the expenses, and the expenses were all kind of consolidated together, and they really didn't make any sense. And so they kind of said, well, maybe this on a per unit basis, this should be probably about $2,300 a door. Well, in that marketplace, it should be $3,700 or $3,900 a door annual expenses. So one of the things that they forget to do is take the bump up of what if this property would be in your area, bump up in property taxes, what we're going to have to do in the step up for property taxes. Insurance is probably one of the biggest things that we're seeing rise on these days, anywhere from 20 to 30% from last year's annual numbers. So we're getting hit real hard on insurance. And then the expenses kind of going through that. So when you see numbers with some of the amateurs, when I say amateurs, these people just don't know. Make sure you talk with a lender that has done multiple transactions that kind of can eyeball to kind of figure out what your expenses should be. Because if you put in $2,000 or $2,300 and you think that's what it's going to cost to operate the property, and when you acquire the property, you will not be able to have $2,200 as your operating expenses. You will choke that property because you're not putting money into the deal, and that starts the big slide. So anything more to add to that, Mike?
No, yeah. I mean, I think especially when you're either new or relatively green in the deal, I think the more help you need. I mean, once you do it after a while, you most of the stuff you kind of understand. But even with that said, I mean, before we ever go, super hard or even 100% confirm that we're gonna do the deal, even if we're not signed a contract, I make sure we always talk to our insurance broker, make sure our insurance number is tight, talk to our tax consultant, make sure our tax number is tight, and certainly talk to our lenders and make sure that they have the right sizing in, the right spread in, all that stuff, how much IO we can get. I want to make sure I have a really good grasp of that with, 98% certainty before I put in risk capital up because, this real money, you don't want to make mistakes. But even more than the money, a lot of this stuff is your reputation. So we guard that, dearly, that if you have a good reputation, you get these opportunities. And if you start donking a few deals off and you say, oh, I can do this. And then once you realize you made a big mistake and you're off $1,000 on a unit on your expenses and you can't really pay that price, that starts hurting your reputation in the marketplace, and it's going to seriously impede your ability to continue to do deals if you keep making mistakes like that.
Yeah, as I say, 99 attaboys does not equal 10 shit in this multifamily business. I mean, we all come from different places and people underwrite these deals pretty much the same way, but if you don't know that until you start to get in the middle of it. Even if you're an investor, you want to underwrite these deals and make sure that the general partner knows how to underwrite these deals. And so we rely upon a lot of the property management company, because if they're familiar with the area and they have other properties in that marketplace, they're the ones that kind of know what the true expenses are. So insurance, they may not know, taxes, they may not know, but they definitely know about payroll, salaries for maintenance people, for on-site managers. They understand what landscaping costs. Bring that into your equation to figure out what the real number is. So rely upon your property management companies.
And even if they have that, then you need to make sure your banker's going to buy off on that. And even if the banker's going to buy off on it, will the appraiser buy off on it?
Right.
So like it could go down 3 levels. So especially if you're talking about going hard with a bunch of money, having surety of execution and going and running those traps before you start putting risk capital, that really helps. And then if you can also, it helps you even winning these deals that I'm talking to the broker in the deal saying, hey, I've checked these 10 different boxes. I've got a budget of my management company. I've talked to my lender. We talked to the appraiser. The appraiser bought off on this payroll number or this R&M number or whatever it is that, so we're pretty sure we're going to get it. I already got my quote from my insurance guy. So that number's tight, that these are all these little risk points that you're taking out of this deal that just increase the likelihood of you closing, which would then increase the likelihood of that listing agent recommending to the seller that they choose you over the next buyer.
Most of the time when you buy a single family home, you will have limited contact between the seller and you. In fact, you'll probably never see them until you actually probably get the keys, and you may see them just for a slight period of time of them walking out of the title company. Multifamily business is completely different. They may interview you to figure out if you're the right buyer on these deals. Michael, tell me a little bit about on this last transaction that you guys are under contract on. Were you interviewed by the seller? Did you meet the seller? Was there any questions that the seller had for you?
This one, no, but early in the year we went and shot birds and drank whiskey together in the middle of nowhere, Texas, and happened to meet him. And then the deal came back around, and it was kind of put 2 and 2 together that, you'd met so-and-so, but, I transacted with the broker multiple times. We own the deal next door to it. I own another deal in the market. I'm the natural buyer. I've done 38 deals, so the reputation kind of precedes you where you don't need to go through all that. This was an off-market deal on that particular deal. So, but yeah, I met him. We had spoken, actually grew up in the next town over from me, even though it doesn't live in Dallas anymore, similar age. So, we have this little history. So that kind of goes back to the thing that I say all the time. It's unfair business, right? It's who you know, what chips you could trade, and people do business with the people they know, like, and trust. And they're not going to get to know, like, and trust you unless you go to events, meet people, go to these broker events. This past week, the last 2 days, spoke at a conference. There was, 100 and some odd people at this conference there. And the night before, I went to a broker, had a dinner, kind of the state of the economy. And there was, 50, 60 people there. And you just get to kind of meet these people, have a conversation, and then, never know 2 years down the road that you might be on the opposite side of a transaction, and then you could say, oh, well, I met you at this thing, we had this conversation, and then you're a real person. Those little edges can tip that deal your way.
How do you get invited to these conferences?
So you buy deals and you close, right? So you do.
Yeah, but I'm talking about for babies, people that are just getting to the business, whether they're limited partners. Should they be going to, say, the Old Capital Conference for one?
What's our ticket price to the Old Capital Conference, Paul?
$350.
So to spend $350, either you drive or you get on a Southwest jet. You come to Dallas, and you know who's going to be there. I'm moderating a panel. We have 4 of the top realtors and multifamily in Texas. We have Dallas, Fort Worth, Austin, and San Antonio represented up on my panel alone. Plus, there's going to be many, many other ones there as well. On top of that, for $300, you could walk in and meet any one of those guys and have a conversation with them and start at least forming that initial in-person, personable relationship with these brokers. And then, go to these events, meet them, tour the deals, reference that conversation. Hey, I met you here at this event, and we talked about this.
That's just a little spark of a forest fire that comes behind you meeting these folks.
And you never know what little thing is going to tip it your way or not tip it way. You just never know, right? And it's hard in the moment because you work for free all the time because you're doing these things, and there's not immediate gratification. But, these things 2 years down the road might come back and pay off. And I can't tell you how many times that's happened for me. And then the more you do, the easier it gets.
So if people want to know a little bit more about what SPI does, again, what does SPI stand for? This is the company that you guys own and operate?
Yeah, so my day job is running SBI Advisory. So when I'm not hosting podcasts with Paul, that's what I do. But SBI Advisory stands for Strategic Property Investment. So SBIadvisory.com or SPI like spy advisory.com. Go to our website. There's a contact us form there. Fill that out, and I'm always happy to have a 10 to 15 minute telephone call with listeners I meet off of the podcast. If you guys are interested, maybe potentially investing with us, or we're always happy to have these conversations.
What type of properties are you guys typically buying? Is it
today we're buying anywhere from B to A. With my most favorite part of the marketplace today is kind of that A- product, Paul. So and tech, we focus in Dallas, Fort Worth, and Austin.
What does that mean?
Yeah, it's A-, B plus A- is kind of semantics, but think of in Texas, when I think of C class, I think of like 1960s, 1970s vintage. When I think of B class, I generally think like 1980s kind of vintage year construction. When I think of A, I probably A plus, I kind of think of maybe 2012, 2013 newer. The last 5 or 6 years, and kind of that B plus A- in Texas is kind of mid 90s all the way to about 2008, 2009, kind of that pre-recession stuff. And that's really kind of my most favorite part of the marketplace. They tend to have inferior interiors, kind of similar. They didn't build them as nice back 15 years ago, Paul. They had white appliances and cheaper, cabinet fronts and light fixtures and plumbing fixtures, but they had 9-foot ceilings and PVC sewers. So they had better construction components than they did, say, in the 80s. Where the 80s, you have 8-foot popcorn ceilings, and in the 90s and 2000s, you have 9-foot smooth ceilings. But they don't knock them out with granite or quartz and stainless and the better cabinets and stuff like that. So you can still buy these deals for some value, spend a little bit of money improving the product, increase the rents. So it operates and functions very similar to the B class stuff or the C class stuff. It just, it's not 50 years old, and you have all these functionally obsolescent technologies that you have, like boiler systems and, flat roofs that leak and asphalt parking lots and maybe aluminum wiring and all this stuff that we had to deal with when we started in career. So it's kind of the best of both worlds. The struggle a little bit for a lot of people that are trying to transition up is just the equity checks tend to be a little bit larger. So, you have to write $10 or $20 million equity checks to do these deals, where you can do a C-class deal for a $3 million equity check, or maybe a B-class deal for a $5 or $8 million equity check. So the price of poker goes up, but, there's a lot less competition in that price range as we talk right now in the marketplace.
Yeah, to buy the higher quality assets.
And the cap rate says it's just kind of the market's evolved. The cap rates are basically the same whether you buy a 1974 vintage deal or a 2004 vintage deal. So in my mind, it just makes a little bit more sense on a risk-adjusted basis to buy a little better quality stuff.
Again, if somebody wanted to get more information, what's the web?
SBIadvisory.com. Fill the contact us form out, and I'm always happy to set up a call with listeners off the podcast.
That sounds great. Again, we're trying to get 1,000 likes, 1,000 5-star reviews on iTunes before the end of the year. We would certainly appreciate if you took just 2 minutes of your time, just went back into iTunes and leave us a 5-star rating if you thought we brought value to this podcast. Again, the mayor, the governor of the great state of Texas, Mr. Michael Becker, we appreciate you being with us. Again, I'm Paul Peebles. Have a great day.